So now we're going to have our topic, which are the derivatives. So in this report, we're going to talk about the introduction of derivatives. We have option and the two option pricing model, which are the binomial and the Black-Scholes option pricing model. So first, we're going to define first what are derivatives. So derivatives are securities whose values are determined by the market prices or interest rates of other assets. So derivatives includes options whose values depend on the prices of underlying assets. We have also interest rate and exchange rate futures and swaps whose values depend on interest rate and exchange rate levels. And lastly, we have commodity futures whose values depend on commodity prices. And then we have also natural hedges. These are situations in which aggregate risk can be reduced by derivatives transactions between two parties known as counterprices. They exist for many commodities, foreign currencies, interest rates on securities with different maturities, and even common stocks where portfolio managers want to hedge their. So natural hedges occurs when futures are traded in between like cotton farmers and cotton mills, copper mines and copper fabricators, importers and foreign manufacturers for currency exchange rates, electric utilities and coal miners, and oil producers and oil users. So in all of these situations, hedging reduces aggregate risk and thus benefits the economy. So hedging can also be done in situations where no natural hedge exists. In these situations, one party wants to reduce some type of risk and another party agrees to sell a contract that protects the first party from that specific event or situation. So example of this is the insurance. And then for a number of reasons, the derivatives markets have grown more rapidly than any other market in recent years. So first, the analytical techniques such as the Black-Scholes option pricing model have been developed to establish fair prices. So having a better basis for pricing hedges makes the counterparties more comfortable with deals. Second, computers and electronic communications make it much easier for counterparties to deal with one another. And then third, globalization has greatly increased the importance of currency markets and the need for reducing the exchange rate risk brought on by the global trade. So recent trends and developments are sure to continue if not accelerate. So the use of derivatives for risk management is bound to grow. So note though that derivatives have a potential downside. So these instruments are highly leveraged, so small miscalculations can lead to huge losses. Also, because they are complicated, most people do not understand them well, so consequently, mistakes are more likely to occur than with less complex instruments, and it makes it harder for a firm's top management to exercise proper control over derivatives transactions. So, we have here options. So, options are a contract that gives its holder the right to buy or sell an asset at predetermined price within a specified period of time. So we have also here strike or exercise price, the price that must be paid for a share of common stock when an option is exercised. And then we have also call option, an option to buy or call a share of stock at a certain price within a specified period. So there are many types of options and option markets. So to illustrate how options work, it's going to have this. So suppose you owned 100 shares of EBC Incorporation, which on Tuesday, September 2, 2018, sold for 165.75 pesos per share. So You could sell to someone the right to buy your 100 shares at any time during the next 7 months at a price of 180 pesos per share. So, the 180 pesos per share here is called the strike or exercise price. And then, such options exist and they are traded in a number of exchanges. So, this type of option is defined as call option because the purchaser has a call on 100 shares of stock. So, the seller of an option is called the option writer, and an investor who writes call options against stock held in his or her portfolio is said to be a covered options. Then, options sold without a stock to back them up are called naked options. And then when the exercise price exceeds the current stock price, a call option is said to be out of the money. And then when the exercise price is below the current stock price, and the option is in the money. And then next, we have also put option, an option to sell a share of stock at a certain price within a specified period. So, for example, let's take a look on the table. Then, suppose you think that Netflix stock price is likely to decline from its current level of 167.85 sometime during the next month. So, you could buy a 1-month put option for 219 for 219 pesos. So that derived that's example, if on September 15, 2017, so we have here 2.19, and then we're going to multiply it on 100. That would give you the right to sell 100 shares at a price of 160 pesos per share. So 160 is the strike price, and suppose you bought this 100 share contract for 219 pesos, and then Netflix stock fell to 150 pesos. So you could um, buy a share of stock for 150 pesos and exercise your put option by selling the stock for 160 pesos, the strike price. And then your profit from the exercising option would be, you could have 1,000 pesos from 160 pesos, a strike price deducted by the 150 pesos, and then multiplied by the 100 shares, so you have 1,000 pesos. So after subtracting the 219 pesos you paid for the option, your profit would be 781 pesos. Si 219, you've got to deduct it from the 1,000 nga imuhang na profit. The next, we have long-term equity anticipation security, or LIPS. So, it is a long-term option that is listed on the exchanges and tied to the individual stocks and stock indexes. So, the major difference is that LIPS options are long-term options having maturities of up to 3 years. So, unlike conventional options that are generally written for 7 months or less. And then, a 1-year LIPS costs about twice as much as a matching 3-month option, but because of its much longer time to expiration, a LIPS provides buyers with more potential for gains and offer better long-term protections for a portfolio. Then we have here factors that affect the value of a call option. So first, we have the higher the stock's market price in relation to the strike price, the higher the call option price also. Then we have here the higher the strike price, the lower the call option price. And then third, we have the longer the option period, the higher the option price. So this occurs because the longer the time before expiration, the greater the chance that the stock price will climb substantially above the exercise price. So thus, option prices increases as the expiration date is lengthened. And then we have here, how is the actual price of a call option determined in the market? So um we present a widely used model, the Black-Scholes model, which we're going to tackle in the next few slides for pricing call options. But first, it is useful to establish some basic concepts. So to begin, we define a call option's exercise value as follows. So for a call option, it is the difference exercise value is the difference between the current stock price and the option's strike price. So the exercise value is what the option would be worth if you had to exercise it immediately. So, for example, if a stock sells for 50 pesos and its option has a strike price of 20 pesos, you could buy the stock for 20 pesos by exercising the option. You would own a stock worth 50 pesos, but you would have to pay only 20 pesos. So therefore, the option would be worth 30 pesos if you had to exercise it immediately. Note that the calculated exercise value of a call option could be negative, but realistically, the minimum true value of an option is zero because no one would exercise an out-of-the-money option. Note also that an option's exercise value is only a first approximation of the option's value. It merely provides a starting point for finding the actual value of the option. So, we're going to take a look here in the graph. So, this presents some data on a company that recently went public and whose stock price has fluctuated widely during its short history. So, as we can see, any stock price below $20, the exercise value is set at 0. But above $20, each $1 increase in the stock price brings with it a $1 increase in the option's exercise value. So, however, that the actual market price of a call option lies above the exercise value at each price of the common stock, although the premium declines as the stock price increases above the strike price. So, for example, we from the graph, when the stock sold for $20 and the option had a zero exercise value, its actual price and the premium were $9. Then as the stock price rose, the increase in exercise value matched the stock's increased dollar for dollar, but the market price of the option climbed less rapidly, causing the premium to decline. So the premium was $9 when the stock sold for $20 a share, but it had declined to $1 by the time the stock price had risen to $73 a share. So beyond that point, the premium virtually disappeared. So why should a call option ever sell for more than its exercise value? And why does the premium decline as the stock price increases? So the answer lies in part in the speculative appeal of options. So they enable someone to gain a high degree of personal leverage when buying securities. And then, why does the premium decline as the stock price rises? So part of the answer is that both the leverage effect and the loss protection feature decline at high stock prices. So next we have the uh, introduction to option pricing model. So first we're going to define riskless hedge. So a hedge in which an investor buys a stock and simultaneously sells a call option on that stock and ends up with a riskless position. So nearly all option pricing models are based on the concept of riskless hedge. So we're going to introduce the two types of option pricing model or OPM. We have binomial option pricing model and the Black-Scholes option pricing model. So first, we're going to talk about the binomial option pricing model. So an option pricing model based on a riskless hedge with two scenarios for the value of the underlying asset. So we're going to take an example. This like we're going to have an assumptions with the using this example. So the stock of Western Cellular, a manufacturer of cell phones, sells for $40 per share. So options exist that permit the holder to buy one share of Western at an exercise price of $35. These options will expire at the end of 1 year, at which time Western's stock will be selling at one of two prices, $30 or $50. Also, the risk-free rate is 8%. So based on these assumptions, we must find the value of the options. So we're going to use the binomial option pricing model. Then that's the assumption is the first step. So the second step is to find the range of values at expiration. So when the option expires at the end of the year, Western's stock will sell for $30 or $50. And here is a situation with regard to the value of the option. So ending stock price, we have $30 and then $50. And then the strike price value, which is $35. And we have the ending option value. So we're going to since $30, the ending stock price is lower than the strike price value, so we're going to have an ending option value of 0. So option is worthless because lowest value is 0. And then $50, we're going to deduct the strike price value of 35, so we have an ending option value of 15. So we're going to sum up the ending stock price, the $30 and the $50. We're going to deduct we're going to deduct $30 from the $50, so we have $20. And then we're going to add the ending option value, which is $15. So our range runs from $20 to $15. The next step, we have to equalize the range of payoffs for the stock and the option. So as just shown, the ranges of payoffs for the stock and the option are $20 and $15 respectively. So to construct the riskless portfolio, we need to equalize these ranges. So we do so by buying 0.75 share and selling one option to produce the following situation where the range of ending values for both the stock price and the option value is 15. So we have here the ending stock price. We're going to multiply it on 0.75 share, and then we have an ending value of stock of 22.50, and same goes also with the $50 multiplied by 0.75 is equals to 37.50. So we had an ending value of option for the $30. We have 0 as shown in the second step, and then the ending option value of the $50, which is 15. So we come up with this in this step, we came up with the ending value of stock. So we're going to deduct 37.50 with the 22.50, so we came up with 15. which equalizes the ending value of the total ending value of the option, which is 15. So, next step, we have to create a riskless hedge investment. So, we can now create a riskless investment portfolio by buying 0.75 share of Western's stock and selling one call option. So, here is the situation. So, ending stock price $30 and $50 multiplied by 0.75. So, we have here the ending value of stock price in the portfolio is $22.50 for the $30. We're going to add the ending value of option in the portfolio, which is 0. Then ending total value of the portfolio is $22.50. And then for the $50 ending stock price multiplied by 0.75 is equal to 37.50. And then we have the ending value of option in the portfolio, which is 15. We're going to subtract it to 37.50. So we came up with 22.50. So it equals. So the fifth step is we have the pricing the call option. So the value of the portfolio will be 22.50 at the end of the year, regardless of what happens to the stock price. So this $22.50 is riskless. So the risk-free rate is 8% as stated in the problem. So the present value of the riskless $22.50 year-end value is as follows. So PV is equal to $22.50 divided by 1.08. So it equals to 20.83. And then, because Western's stock is currently selling for $40 and because the portfolio contains 0.75 share, the cost of the stock in the portfolio is as follows. So we're going to multiply 0.75 share by $40. So we have $30 cost of the stock in the portfolio. And then lastly, we have if you paid $30 for the stock and if the present value of the portfolio was 20.83, the option will have to sell for at least $9.17. So, yun sa pagkuha. Price of option is equal to cost of stock minus PV of portfolio. So, $30 minus $20.83 is equal to 9.17. So, 20.83, this is the PV of the portfolio subtracted to $30, so we came up with 9.17. And then, next, we have the Black-Scholes option pricing model. So, derived from the concept of a riskless hedge, this model calculates the value of an option as the difference between the expected PV of the terminal stock price and the PV of the exercise price. So, Black-Scholes option pricing model involves 3 equations. So, 3 equations here, and then we have the meaning of each letter or each what comprise the formula. So, the Black-Scholes models, the derivation on this pricing model involves extremely complicated mathematics that go far beyond the scope of this introductory finance text. So, however, it is not difficult to use the model. Under the assumptions set forth previously, if the option price is different from the one found, there is an opportunity for arbitrage profits, which will force the option price back to the value indicated by the model. So, as noted earlier, the Black-Scholes model is widely used by traders, so actual option prices conform reasonably well to values derived from the model. So, next reporter, Ms. Sanchez, were able to give some examples on Black-Scholes model. And then next, we have the effects of option pricing model factors and the value of call option. So, you have here the factors of current stock price, exercise price, time to expiration, risk-free rate, and then stock return volatility. So, the current stock price, as the current stock price, time to expiration, risk-free rate, and stock return volatility increases, the option value also increases. However, on the contrary, when as the exercise price increases, the option value decreases. So that's all, and thank you.
So, hello everyone. This is the continuation to Mary Jeann's report, Derivatives. So, these are the agenda to be discussed. Just like I said, in continuation to Mary Jeann's report, I will provide examples of call option and put option exercise value, premium of option, and the Black-Scholes option pricing model. Next, the forward contracts. Future contracts. Under future contracts, we have commodity futures and financial futures. Next, other types of derivatives. We have swap, structured notes, and inverse floater. And then for the last, using derivatives to reduce risk. So first, we have the example. Number 1, a 6-month call option on Ramer Technology stock has a strike price of 45 pesos and sells in the market for 8.25 pesos. Ramer's current stock price is 48 pesos. What is the exercise value of the option? So, given here, we have strike price 45 pesos and the stock price of 48 pesos. So, in getting the exercise value, we will use the formula current price of stock minus strike price. So 48 pesos minus 45 pesos, we have 3 pesos exercise value. So another example, number 2, a 6-month put option on Mackler Corp's stock has a strike price of 45 pesos and sells in the market for 8.90 pesos. Mackler's current stock price is 41 pesos. What is the exercise value of the option? So this time put option. So in getting the put option, we'll use the formula strike price minus the current price of stock. So it is just the reciprocal of the call option. So we have 45 pesos minus 41 pesos. So we have 4 pesos put exercise value. So next, example 3. A 6-month put option on Smith Corp stock has a strike price of 45 pesos and sells in the market for 8.90 pesos. Smith's current stock price is 41 pesos. What is the option premium? So this time, the option premium, we have the given strike price 45 pesos, option value 8.90 pesos, and then for the stock price, we have 41 pesos. So in getting the option premium, we have here strike price minus current price of stock to get the exercise value. And then after getting the exercise value, we will use option value minus exercise value to get the option premium. So substitute the value, 45 strike price pesos and minus 41 pesos current price of stock equals to 4 pesos exercise value. And then after that, in getting the option premium, we will use the option value 8.90 pesos minus the 4 pesos exercise value equals to 4.90 option premium. And then another example. So we have here the given strike price 45 pesos, option value 8.25 pesos, and then stock price is 48 pesos. So this time we have the call option. There's a call of put option, so we will use current price of stock minus strike price equals exercise value. Then it's just the same in getting the option premium, option value minus exercise value. Then substitute the values. We will get the 5.25 option premium. And then for the last question, we have Lisa Company's stock price is currently 30.25 pesos. A 6-month call option on Lisa stock has a strike price of 25 pesos and has an expected volatility of 40%. The risk-free rate is 6%. According to the Black-Scholes option pricing model, what is the value of the option? So we have here the given stock price or the P, 30.25 pesos, strike price X, 25 pesos, risk-free interest rate, we have 6% or 0.06, time of expiration, we have 0.50, and then for the standard deviation, we have 40% or 0.40. So before getting the value of the option, we will get the D sub 1 and the D sub 2. So in getting the D sub 1, we will use this formula, natural logarithm of P over X, or the stock price over strike price plus the risk-free interest rate plus the quotient of standard deviation squared divided by 2, and then multiplied by the time or the option period divided by standard deviation multiplied by the square root of time. So substitute the value. We will now arrive to the answer 0.92144 for the D sub 1. Next, in getting the D sub 2, we have the formula D sub 1 minus standard deviation multiplied by the square root of time. So let's substitute the values, and now we get the 0.6386. So after getting the D sub 1 and the D sub 2, we will now get the areas under a standard normal distribution curve. So in the D sub 1, we will locate the 0.92, and then we have here the probability that will occur in a standard normal distribution. In the D sub 1, we have 0.8212. And then here, we will locate the area under a standard normal distribution curve of D sub 2. We have 0.64, and then we have the probability of 0.7389. So after getting the probabilities, we will now get the value of the call option. So this is the formula in getting the value. So P multiplied by the probability of D sub 1 minus X E to the power of negative risk-free interest rate multiplied by the time, and then multiplied by the probability of D sub 2. So we will substitute the value, and then for the E, it is already fixed, 2.7183. So we will just substitute the values, and then we will have the value of the call option, 6.9147. So that's all for the example. Let us move on to the forward and futures contracts. Forward contracts are agreements where one party agrees to buy a commodity at a specific price on a specific future date and the other party agrees to make the sale. Goods are actually delivered under forward contracts. Unless both parties are financially strong, there is a danger that one party will default on the contract, especially if the price of the commodity changes markedly after the agreement is reached. Next, futures contract, standardized contracts that are traded on exchanges and are marked to market daily, but where physical deliveries of the underlying asset is never taken. So next, a futures contract is similar to a forward contract but with three key differences. Number one, futures contracts are marked to market on daily basis, meaning that gains and losses are noted and money must be put up to cover losses. This greatly reduces the risk of default that exists with forward contracts. Number two, with futures, physical delivery of the underlying asset is never taken. The two parties simply settle with cash for the difference between the contracted price and the actual price on the expiration date. Third, futures contracts are generally standardized instruments that are traded on exchanges, whereas forward contracts are generally tailor-made, are negotiated between two parties, and are not traded after they have been signed. So futures and forward contracts were originally used for commodities such as wheat, where farmers would sell forward contracts to millers, enabling both parties to lock in prices and thus reduce their risk exposure. And now, we have future contracts are divided into two classes, the commodity futures and financial futures. So first, we have commodity futures are a contract that is used to hedge against price changes for input materials. It covers oil, various grains, oilseeds, livestock, meats, fibers, metals, and wood. Were first traded in the United States in the mid-1800s. Next, financial futures are contracts that is used to hedge against fluctuating interest rates, stock prices, and exchange rates. They were first traded in 1975, include treasury bills, notes, bonds, certificates of deposits, euro-dollar deposits, foreign currencies, and stock indexes. So next, other types of derivatives. So options, forwards, and futures are among the most important classes of derivative securities. But there are other types of derivatives, including swaps, structured notes, inverse floaters, and a host of other exotic contracts. So first we have swap, the exchange of cash payment obligations between two parties, usually because each other prefers the terms of the other's debt contract. So a swap is just what the name implies. Two parties agreed to swap something, generally obligations, to make specific payment streams. Most swaps today involve interest payments or currencies. So it is where a company wishes to receive a fixed rate to hedge interest rate exposure. So we have an illustration of the interest rate swap. So suppose company S has a 20-year, $100 million floating rate bond outstanding, while company F has a $100 million 20-year fixed rate issue outstanding. Thus, each company has an obligation to make a stream of interest payments, but one payment stream is fixed while the other will vary as interest rates change in the future. Now, suppose company S has stable cash flows. and it was to lock in its cost of debt. Company F has a cash flows that fluctuate with the economy, rising when the economy is strong and falling when it is weak. So recognizing that interest rates also move up and down with the economy, Company F has concluded that it would be better off with variable rate debt. So if the company swapped their payment obligations, an interest rate swap would occur. So Company S would now have to make fixed payments, which is consistent with its stable cash inflows, and Company F would have a floating stream, which for it is less risky. And then for the next, another type of swap, the currency swaps, are similar to interest rate swaps. So in a currency swap, the counterparties exchange given amounts in the two currencies. So for example, one party might receive 100 million British pound while the other receives $125 million. This implies a GBP over USD exchange rate of 1.25. So next we have structured note, a debt obligation derived from another debt obligation. So structured note is a debt security issued by financial institutions. Its return is based on equity indexes, a single equity, a basket of equities, interest rates, commodities, or foreign currencies. The performance of a structured note is linked to the return on an underlying asset, group of asset, or index. So we have an example. It would be a 5-year bond coupled with a futures contract on almonds. So another important type of structured note is backed by the interest and principal payments on mortgage. So the advantages of structured notes, the flexibility of structured notes allow them to provide a wide variety of potential payoffs that are difficult to find elsewhere. Structured notes may offer increase or decrease upside potential, downside risk, and overall volatility. So next, inverse floater, a note in which the interest rate paid moves counter to market rates. So a floating rate note has an interest rate that rises and falls with some interest rate index. So for example, the interest rate on a $100,000 note at prime plus 1% will be 1.25% when the prime rate is 4.25%. And the notes rate will move up and down with the prime rate because the cash flows associated with the note and the discount rate used to value it rise and fall together. The market value of the note is relatively stable. With an inverse floater, the rate paid on the note moves counter to market rates. Thus, if interest rates in the economic rose, the interest rate paid on an inverse floater would fall, lowering its cash interest payments. At the same time, the discount rate used to value the inverse floater's cash flows would rise along with the other rates. Thus, inverse floaters are exceptionally vulnerable to increases in interest rates. So, if interest rates fall, the value of an inverse floater will soar. So next, using derivatives to reduce risk. Firms are subject to numerous risks related to interest rate, stock price, and exchange rate fluctuations in the financial markets. For an investor, one of the most obvious ways to reduce financial risk is to hold a broadly diversified portfolio of stocks and debt securities, including international securities and debt of varying maturities. However, derivatives also can be used to reduce the risk associated with financial and commodity markets. So we have here a derivative, security price exposure to reduce risk. Firms are exposed to losses due to changes in security prices, when securities are held in investment portfolios, and firms are exposed to losses when securities are being issued. So in addition, firms are exposed to risk if they use floating rate debt to finance an investment that produces a fixed income stream. So, risk such as this can often be mitigated by using derivatives. So derivatives are securities whose values stem or are derived from the values of other assets. Thus, options and futures contracts are derivatives because their values depend on the prices of some underlying assets. So, let us further explore the use of two types of derivatives, the futures and swap, to help in managing certain types of risk. So first, the futures. So futures contracts were invented to reduce risk for producers, consumers, and investors because they can be used to hedge all sorts of positions in various asset classes. They are used to reduce risk. Futures are used for both speculation and hedging. So speculation involves betting on future price movements, and futures are used because of the leverage inherent in the contract. Hedging, on the other hand, is done by a firm or an individual to protect against a price change that would otherwise negatively affect profits. So we have an example. Rising interest rates and commodity prices can hurt profits, as can adverse currency fluctuations. If two parties have mirror image risk, they can enter into a transaction that eliminates as opposed to transfers risk. So this is a natural hedge. Of course, one party to a futures contract could be a speculator and the other a hedger. Thus, to the extent that speculators broaden the market and make hedging possible, they help decrease risk to those who seek to avoid it. So there are basic types of hedges. First, we have long hedges, in which futures contracts are bought in anticipation of or to guard against price increases. So meaning, a long position means the buyer of the commodity is making a bet that the price of the commodity will rise in the future. If the good rises in price, the profit from the futures position helps to offset the greater cost of the commodity. So we have an example. We might assume that it is January, and an aluminum manufacturer needs 25,000 pounds of copper to manufacture aluminum and fulfill a contract in May. The current spot price is $2.50 per pound, but the May futures price is $2.40 per pound. In January, the aluminum manufacturer would take a long position in a May futures contract on copper. So this futures contract can be sized to cover part or all of the expected order. Sizing the position sets the hedge ratio. For example, if the purchaser hedges half the purchase order size, then the hedge ratio is 50%. So if the May spot price of copper is over $2.40 per pound, then the manufacturer has benefited from taking a long position. This is because the overall profit from the futures contract helps offset the higher purchasing costs paid for copper in May. So, another scenario, if the May spot price of copper is below $2.40 per pound, the manufacturer takes a small loss on the futures position while saving overall thanks to a lower than anticipated purchasing price. So next, for the long hedge, we have short hedges, where a firm or an individual sells futures contracts to guard against price declines. In other words, short hedge is an investment strategy used to protect against the risk of a declining asset price in the future. So we have an example. Assume that John, a corn producer, knows he will be selling grain at harvest 3 months from now. And then we have another type of hedge. Perfect hedge is a position undertaken by an investor that would eliminate the risk of an existing position, or a position that eliminates all market risk from a portfolio. In order to be a perfect hedge, a position would need to have a 100% inverse correlation to the initial position. As such, the perfect hedge is rarely found. So we have another derivative that can reduce risk. A swap is another method for reducing financial risk. As noted earlier, a swap is an exchange. Swaps can be used to lower borrowing costs and generate higher investment returns. Swaps can be used to transform floating rate assets into fixed rate assets, and vice versa. In finance, it is an exchange of cash payment obligations in which each party to the swap prefers the payment type or pattern of the other party. In other words, swaps occur because the counterparties prefer the terms of the other's debt contract, and the swap enables each party to obtain a preferred payment obligation. So the currency swap market is one way to hedge that risk. Currency swaps not only hedge against risk exposure associated with exchange rate fluctuations, but they also ensure receipt of foreign monies and achieve better lending rates. So we have another commodity price exposure in reducing risk. So commodity price risk is the chance that commodity prices will change in a way that causes economic losses. Commodity price risk for buyers is due to increases in commodity prices. For sellers, producers, it is often due to decreases on commodity prices. Producers and buyers can protect themselves from fluctuations in commodity prices by purchasing a contract that guarantees a specific price for a commodity. They can also lock in a worst-case scenario price to reduce potential loss. So next we have use and misuse of derivatives. Most of the news stories about derivatives are related to financial disasters. Much less is heard about the benefits of the derivatives. However, because of these benefits, more than 90% of large U.S. companies use derivatives on a regular basis. In today's market, sophisticated investors and analysts are demanding that firms use derivatives to hedge certain risk. So, if a company can safely and inexpensively hedge its risk, it should do so. So, there can, however, be a downside to the use of derivatives. Hedging is invariably cited by authorities as a good use of derivatives, whereas speculating with derivatives is often cited as a bad use. Some people and organizations can afford to bear the risk involved in speculating with derivatives, but others are not sufficiently knowledgeable about the risk they are taking or should not be taking those risks in the first place. So most would agree that the typical corporation should use derivatives only to hedge risk, not to speculate in an effort to increase profits. Because in the world of finance, speculation or speculative trading refers to the act of conducting a financial transaction that has substantial risk of losing value. Hedging allows managers to concentrate on running their core businesses without having to worry about interest rate, currency, and commodity price variability. However, problems can arise quickly when hedges are improperly constructed or when a corporate treasurer, eager to report relatively high returns, uses derivatives for speculative purposes. So that is all for the report of Group 6. That is all for the report of Group 8. So thank you for listening.